Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me for this show is Clint Sorenson, the Chief Investment Officer at WealthShield. Today, Clint and I are going to talk about a presentation that he recently did for his organization on the margin of safety. We're going to go deep into what they see in the economy today and where there are opportunities. Clint, you're a longtime guest of the show. Your business has evolved dramatically since we ever spoke about your business. You've always been very gracious to just come on and share content and share your wealth of knowledge. Tell us a little bit about what's going on at WealthShield.
Yeah, so WealthShield just continues to expand. We're announcing a partnership with another platform that'll be coming out shortly. We're really excited about, and we just continue to progress to try to become a really good, thoughtful business. Right, we want to make a huge impact on end clients through financial advisors. We want to continue to broaden out our range of services. And so that's what we continue to work towards. We continue to grow. Obviously, COVID hurts. As you know, big part of my business is traveling. So right. It hurts from that respect, but I feel like I'm so much more productive. I do Zoom calls every day, and we just continue to try to add value to our clients, and they're appreciative. So just very excited about the future of what we're doing. We're trying to fight the good fight with the financial advisor. We really believe in the independent movement and helping advisors when they get to be independent to have the resources they need to have a business. So really excited about what we continue to do there, and very excited about what the future holds.
Excellent. Everybody's life has changed. I see the Peloton bike in the back.
That's right.
Has that been your go-to exercise during the pandemic?
That, and I've got a jiu-jitsu dummy. I'd pull it out of the closet if you want to see it, but just trying to do what I can to stay in shape. Do a lot of body weight exercises, a lot of Peloton, obviously, and then I try to get outside as much as possible. And I've been walking while on the phone, which has been awesome. I kind of apologize on the front end if I become winded, but I just go on these really long walks outside, and it's really nice. Last few days I haven't, because it's been 106 degrees according to the heat advisory, or at least it feels like that, right? But
right.
Yeah, I just try to get out and get as much vitamin D as possible, and enjoy being outside, enjoy family.
Well, I know I've been on several of those walks with you. It's great multitasking. Everybody
it is. It's great.
Well, before we get started, I want to announce a new program that I'm launching in conjunction with a partner of mine, Joe McQuaid. And we are launching something called the Independence Incubator. This is for the wirehouse advisor that is sitting there trying to determine if independence makes sense for them. What we have found is that most advisors, when they go through the process, they start getting all of their information from either a custodian or a recruiter, both of whom have really, really diverse incentives that aren't necessarily aligned with you. If you come and join the incubator, we'll give you a complimentary 1-hour overview of what you want to look at, what you want to look at for, and then if you choose to join, you pay us directly instead of being served by somebody whose incentives might not be in line with yours. If you're interested for more information on that, please visit independenceincubator.com. Clint, that's the first time I've ever done an ad on one of my shows.
Well, you did a great job, and it's needed, right? I mean, there's so much confusion and such a large amount of information. One of my friends says, and he's a great, he runs a firm in an independent broker dealer, and he said there's no due diligence process long enough, right? I mean, it just, there's so much information, so much stuff so many rocks you got to overturn. So I think what you're doing is fantastic, and I can't wait to see the success you're going to have with it.
Oh, man. Well, let's get started. Let's talk about the margin of safety conceptually, because I thought it was just a great read and a great listening your presentation a couple of weeks ago. Let's talk conceptually about it and then dig into the numbers.
Yeah. So, margin of safety is just another term for buying something that's undervalued, right? Because the theme is if you buy something that's depressed below fair value, that you have a lot more room, right, to be wrong, right? Because at the end of the day, you're already depressed. So the theory is that if it continues down, there's only so far it can go. Now, I just like the term because if you look at the data, and I know you've seen this in our white papers, and we featured it in our quarterly outlook. If you look at the data, when you buy something from a high valuation, so just take market cap to GDP, for instance, the Buffett indicator. If you buy in the top quartile, you have really low returns on rolling 10-year, 12-year, 7-year basis. You have really, really low returns. So you have no margin of safety there, essentially, when you buy something highly valued. On the flip side, if you buy something low value, right, you tend to have the higher average returns over the next 7, 10, 15, 20 years. And that just goes to say, hey, you have a better margin of safety there. And also you have lower drawdowns. So you have a lot lower drawdowns when you buy from lower valuations historically than you do when you buy from higher valuations. So that margin of safety just says, look, if you do the work and you buy something that's low valued, right? I hate to use the words over and under. I don't even know what that means. It's either high historically or low historically. But if you're buying something low, historically speaking, you got a margin of safety there where the drawdowns are lower and your prospective returns are higher. And that's exactly what you want to do.
Yeah. And you went deep on the projected 10-year returns for some of these more popular asset classes right now, particularly growth and large cap here in the US. As allocators, what are portfolio managers and advisors going to do? What should they do?
I think I actually got into a low point earlier, really, when the Fed came out and started buying high yield bonds. It was a challenging time for me mentally because I had to think a lot about where our business was going to go. How are we going to continue to support advisors in an area where price discovery and essentially free market capitalism, in my opinion, have completely evaporated, right?
Yep.
And with all these distortions, and it caused me to kind of start to second guess not only my trajectory as a support services model, but also whether financial advisors could truly survive. And then it hit me. They can. They're actually needed more. I wasn't thinking about it from a practical standpoint. And so, I've recentered and refocused back on the task at hand, which is in a low return environment and what has worked, right? So large cap growth, large cap equities, the S&P 5, not the S&P 500, right? The S&P 5, even US, bonds, government bonds, even U.S. corporate bonds. When you look at these assets, the way they're constructed today from a market cap perspective, your forward returns are really low. Take GMO's forecast, right? They're a lot smarter than me, right? And if you look at what they say that U.S. equities, the S&P 500, will earn negative 3.6% per year after inflation over the next 7 years. That is not good, right? How can an advisor charge a fee buying an S&P 500 index fund? It's probably not going to work out so well.
That's right.
And so there's, instead of focusing myopically and anchoring, right, or giving into our herd mentality from a behavioral perspective and focusing exclusively on the S&P 500 or the NASDAQ or U.S. Treasury bonds or U.S. corporate bonds, I think we have to start looking elsewhere. And that is what our job is, right, as allocators, is to find not only those areas of margin of safety where the expected returns are highest, but when those trends, as you know, I'm a trend follower at heart, when those trends start to support that thesis, even more importantly, to be prepared to allocate to those areas. Large cap growth has been our overweight, and uncomfortably so, for a very long time. And the reason why is because it's been trending up and it's been the strongest. But that I do see in a lot of what this paper was about, or this quarterly outlook was about, that trend eventually ending. And when it ends, we have a plan as a group on how to allocate out of it, but a lot of advisors don't, and a lot of clients don't, who have moved towards this, I hate to even use this term, but passive or index fund investing. At the end of the day, they're going to be caught off guard, in my opinion, or at least I expect that to happen when that trend changes, because the indices are very concentrated, in particular the S&P 500 or the traditional 60-40, and very few names. And historically, that hasn't worked out well when the trends reverse. So I think it's time to look elsewhere. And I think it's time to start building that list and watching for those trends to change. Some of those trends are changing now. And when they change, be prepared to enter those positions. And obviously always have risk management and, know what to do if you're wrong as well. But I think that's what we have to do. And I'm very excited about the advisors who are able to, quote unquote, grab that bull by its horns because I think there's going to be a significant opportunity to build wealth for clients who are willing to do the painful thing, and that is to move towards these margin of safety trades and out of what's worked so well and what's felt so comfortable.
Well, let's dig into that. You sent over some great slides. Before we do, I want to recognize some of our live viewers who have given us a shout out. Michael Hakaram in North Carolina, Josh Taffer, hope you're doing well down in Mississippi, and Eric Satcher from Montgomery, Alabama. Thank you, everybody, for tuning in. So let's start with your market summary, and then we'll get into some data.
Yeah, for sure. I mean, let's talk about what happened. What's happened over the last year, what's happened year to date. Year to date, it's pretty simple. It's Bitcoin, gold, bonds, right? They're the leaders. U.S. large cap stocks pulling up right after that. If you look at the S&P 500, let's break that down. Really the top 5 stocks, right? Facebook, Alphabet, Amazon, Apple, and Microsoft. They're up 35% year to date. The S&P 495 is down 5% year to date. So that's kind of what you have. You have a bull market in 5 names. You have the rest of the names kind of doing nothing. Average stock really hasn't done anything since the peak of the market cycle in 2018, or peak of the economic cycle. And gold has actually outperformed stocks by, I think, 44% since that peak. And the peak I'm speaking of is October 2018. So pretty substantial trends you're seeing there. And those trends continue, right? I mean, everyone gets so hyped up looking at the stock market going up since the March lows. Market did exactly as it should, right? The market went down because economic growth was slowing already, and then you had a negative catalyst that acted on it, and the trend was down, period. Mm-hmm. So it just kind of accelerated that trend. Then markets got super oversold. At one point, 0 stocks in the S&P 500 were above their 50-day moving average, and you got a rally. You got an oversold rally, and now the market's digesting this, and you've got certain things in positive trends, certain things leading, and certain things lagging. And right now, you continue to see growth leading, but now you're starting to see some shakeups there, right? At least over the last 7 sessions. And you're seeing gold continue to remain strong and outperform stocks. And you've got treasury bonds continue to just march upward. And then Bitcoin and crypto continue to do fantastic. From a factor perspective, on the summary side, you saw the factors that typically do well in a contraction. You see those factors do well. And in particular, the only one that typically does well in a contraction is low volatility. Low volatility did really well during the early stages of the slowdown. So the initial stages where we entered a slowdown in late 2018, earlier globally, low vol outperformed really until almost summer of 19. Low vol was the top performing equity factor. Now it's really, the story is momentum from a factor perspective and high quality. Those 2 factors tend to do well in a contraction. Growth is a style, and momentum kind of picks that up, but we include growth in there as well. And then also from a style perspective or size perspective, it's been all about large caps. We see that changing as we enter recovery. Typically in a recovery, small caps and value do the best. So wouldn't be surprised to see, as we enter a more robust recovery, wouldn't be surprised to see that kind of take over. And then from a sector perspective, it's been all about tech and tech-related sectors. It's been, if you look at the S&P sectors, you have consumer discretionary up there as well. That's because Amazon makes up such a big percentage of that. But technology has just been the clear winner. And again, it's not the technology of the pet.com days, although we still have some of that euphoria present in names like Nikola or other names that are rallying to pretty extreme levels on not a whole lot of fundamental improvement. But the technology names are really the high quality stocks, those same 5 that we mentioned, and then you can include Tesla in that mix as well. So technology's done really well and continues to lead from a momentum perspective. And that's really been the story, right? That's been the story for the last 1 year. It's been the story for the last year to date. And those are kind of the trends in terms of the market summary.
So if I could go a little bit deeper here, and specifically on energy, a lot of advisors have these boomer clients that have held Exxon or Chevron. Some of them may have even gotten it from their parents, and they have low cost basis, and it's really, really hurting their portfolio's performance from an attribution standpoint. Do you have any thoughts on energy over the next 12 to 24 months? And then how should advisors frame that inside of the larger portfolio?
Yeah, so let's take out any, 'cause who knows what's really going to happen. That's why I always go back to that kind of trend following mindset where, whatever happens, happens. But when you think about it academically and you look at, factor exposures and you look at size exposures, you look at styles and how they perform during different economic regimes, I can make the case that value comes back and makes a pretty strong showing in an event like a recovery that has inflation accelerating. So right now, dollar breaking down means inflation's accelerating. So we've gone from what we call the deflationary part of the contraction, where we had growth and inflation both slowing starting in 2018, moving into a contraction earlier this year. Now we're moving into stagflationary contraction, where economic growth from leading indicators has improved, but you got to remember it's not falling as fast. That's really what's happening. There's a big difference between an accelerating growth environment and an environment that's improving. And we're in that improving environment, but we're moving into the stagflationary zone where you have inflation accelerating due to the dollar breakdown. Now, that's creating kind of the necessary precursors when we move into a recovery, when growth actually does start to accelerate. If inflation's continuing to accelerate in that environment due to whatever is creating this dollar breakdown, guess what happens? You get a rotation into inflation-sensitive sectors, and that pivot to energy could be one that could be pretty attractive because energy is really value now. Value is all about energy and financials primarily when you look at like from a sector perspective. And so seeing energy rally, I could easily make the case. We will not be pivoting there until we start to see those trends line up with that thought process. But I could easily make the case by first quarter, second quarter. It depends on, do we get a second wave? What's the fall look like? Lockdowns, et cetera. But I could easily make the case for a resurgence in energy, and it not be a based on demand story, right? Energy demand. It'd be based on the fact that they're cheap assets and people are deploying capital there because the margin of safety is a lot better.
Yeah, I did some work a number of years ago on the 1970s trying to model out what would have worked well in stagflation. And this isn't a recommendation. The large energy companies really helped you maintain your purchasing power if you had a healthy allocation to that in gold throughout the 1970s.
Oh, yeah, the gold trade. I saw if you've looked at that chart that was in that Paul Tudor Jones report, and if you haven't, I highly recommend it. But it shows gold relative to kind of money supply. And you can see it back in the 70s. That was just perfect for that stagflationary environment for sure. Mm-hmm. So we're kind of in that perfect scenario for gold if you want to talk about it. We go back to a deflationary bust, gold works. You allow inflation to run hot and you're still in this growth slowing mode, trying to inch towards a recovery. Mm-hmm. I can make the case for gold there as well.
Yeah. Let's move on to valuations.
Yep.
I've shared with my audience before, I felt like I've wasted 2 decades of my career worrying about valuations, studying models. We learned about it in graduate school through the CFP and SEMA programs. Man, it just seems like a waste of time. This chart kind of lays out why. Talk to us about it.
Yeah, so valuations are a waste of time if your time frame is short. And by short, I mean anything under 7 years. So valuations tell you nothing about how to time the market, all they tell you is what average returns are going to look like over the next, and it's really, I've got to give a shout out to Dr. John Hussman because he's really framed this, but it's, 12 years is kind of where a lot of the variables he's studying. He's been so nice about sharing that information with people who follow him on his website or Twitter. He's been great about sharing that information. And what you see is that, you get the best kind of predictability, if you will, of returns on average over a 12-year period with any valuation metric worth its salt. So valuations tell you nothing about anything shorter than that. And think about how difficult being a value investor it really is when you're considering buying something low or selling something high. And let's just go through an example, right? I wrote about this in our letter, but James Montier of GMO formerly, I think he may still be there, but he wrote the Little Book of Behavioral Investing. He also wrote a bigger book that was kind of based on a lot of the same information in there, The Behavioral Investor, and it's about practical applications. But in this book, he talks about this study where this one individual participant in a psych study has brain monitoring gear, and essentially he's playing a computer simulation game, kind of shuffleball with who he thinks is another participant, but it's really a bot. All of a sudden, they insert another bot, and those two bots start to exclude that person. They monitor the brain waves. Well, what they found is that the same areas of your brain that act up when you break a bone or go through a physical trauma or an injury were the same areas that lit up from being socially excluded. And when you are a value investor, you are purposefully putting yourself through pain because you are contrarian and you're excluding yourself. So you're choosing a very painful path. And that's why it's so difficult to do. I mean, think about what you've seen just on Twitter with people going crazy against Warren Buffett this year because he sold his airlines in March and April, wherever it was, right?
Yep.
And now he's deploying capital in what? Banks and energy. So, he's disciplined to be a value investor because of his time horizon. And I guess he must like pain, or at least he's numb to it now because he's been doing this so long. But it is very challenging for the normal person to do it because they expect, hey, I bought something cheap and it kept going down. Why is that? The margin of safety wasn't a margin of safety. What's going on here? Or I've been buying emerging markets and international because they've been cheap since 2014 relative to the US, and all I've done is underperform and lost clients. It's a very challenging environment. So you're right. It's useless if your time horizon is short. Now, if you're building an asset allocation portfolio and it is a component, like it's a component of our framework that helps us drive assets elsewhere, right? Maybe it's more to trend following when valuations are high, or maybe it's more to alternative investments when valuations are high. You still have to take into account how difficult it is behaviorally for clients and for people to follow. So, it's a fair point, but I think it's all about matching time, your time horizon up with where valuations are effective. And so we use it to kind of drive the long-term asset allocation and how much we want in alts versus how much we might want in, want our top maximum exposure to be in a certain area. But we don't take exposure in those areas until we have trend support. And that is all to manage behavior and our own included.
Right. Well, you have a really robust framework for monitoring a lot of that as well. I'm going to throw it up on the screen now. Walk us through, and we've done this before on the show, but for new listeners, walk us through the 4 components to your framework. Yeah,
for sure. So always start with the long-term valuations, right? So if you look at valuations, where are they? Red means they're high. Green means they're low. So it shows you the contrarian nature there, right? Because green's good, red's bad. And so when they're red, it's typically when things feel the best from a market perspective, like they are today. But that tells us that returns are going to be pretty low in public, because we're talking about a public asset framework. Now we have this and we can measure, funny thing is it kind of correlates with private equity now. Correlates with a lot of these expected returns in some of those areas. But we have this driven down to the asset class and sub-asset class as well. But this is kind of broadly speaking, public assets globally. That's what we're looking at here. And so we always start with that, and that tells us whether we want more private assets, more risk mitigation strategies, we want to allocate more towards trend, we want to shift down our kind of public exposure to markets in general, or at least have levers to pull to do that, i.e. trend following measures. But we always start with that. So that's the long-term picture. What are expected returns going to be? How do we deliver, how do we reach goals or sustain future cash flow or even current cash flow given where valuations are? That's where that we always start. It's kind of that value matters framework. And look, we didn't invent this. This comes from Warren Buffett, and the metrics we use, they all show historical efficacy at correlating inversely with future returns. So future average returns over a long period of time. So we're using a data-informed framework, just very difficult to follow on its own. And we don't advise following it on its own. Well, that solves that 7 to 20 year period, right? What the heck do we do, underneath that? How do we guide portfolios underneath that? So then we go to kind of what we call the Ray Dalio model, right? Which is, and he most famously said that the best predictor of asset class returns are economic growth and inflation. And so that's where our economic growth and then our policy functions come into play. So economic growth, it's really telling us what happens on a 2 to an 8 year time period. you're following your 4-year cycles, you're following shorter term cycles, but you're trying to get an understanding of whether economic growth is accelerating or decelerating. Leading economic indicators and a lot of other indicators, coincident indicators as well, go into that framework. But we're just trying to understand on a year-over-year rate of change basis, are we accelerating or decelerating? It's that simple. And then by understanding that in inflation, we can understand what direction policy is taking, which is where that monetary policy piece comes in. And that has profound effects, right, on not only investment psychology, which is our last piece, but on, frankly, on the way asset prices and get discounted, et cetera, right? Because they control interest rates. So that's where that policy or monetary policy component comes in. And then lastly, we have to have something for the short term and market sentiment, which is just trend following and market momentum is what we measure there. And we look at international stocks, domestic stocks, and we look at high yield bonds to kind of drive that indicator. And then we also have a bunch of intermarket relationships. We study a lot of commodities, a lot of fixed income, intermarket relationships to determine on the short, intermediate, and long term whether the market's trending positive, negative, or neutral. And so by incorporating all these, we get this diversification by time period. We're able to steer clear from making too many changes and guiding our advisors to make too many abrupt moves. And we're able to help them, behaviorally stay disciplined to a framework that has evidence behind it, shows historical efficacy. In all our white papers you've seen, we've tested each component on their own and shown historically what that looks like. And then people who've been following us for a while know that it's kept them composed during difficult times, and it's helped them make some good decisions. So that's all we're trying to do: make good, educated, data-informed decisions. And follow the framework with discipline. And hopefully if we do that without wavering, we'll have good results.
Well, it also helps you identify opportunities. And so I'm going to throw a slide up here of what you see in the marketplace right now as opportunities for advisors to add to their clients' portfolios. Yeah.
So if you look at where the trends are now, right, and you're starting to see these potential reversals, i.e. the first thing has been the dollar, right? The breakdown in the dollar means to us that inflation acceleration is something that is occurring and something we need to really think about how that's potentially moving things. And so you've seen shorter term trends like emerging markets start to outperform US markets on the shorter term, right? What if that spills over in intermediate and long term, especially when you look at emerging markets from an expected return perspective are a lot more attractive than, say, large cap growth. When the NASDAQ has more market cap than the rest of the world combined, something's out of whack. And so I think that's a bet that makes sense to me from a margin of safety perspective. So the opportunity's there, but now you're starting to see the trends support that. That is an awesome opportunity.
It's so difficult for an advisor to get an allocation into emerging markets. It's a psychological barrier because they've been burned so many times if they've been in the market, longer than this bull market.
That's right. I mean, it's an area where we've been optimistic about for a long time, but we've been underweight. Because guess what? The trend there has not supported it. The trend has supported U.S. stock overweight. So we're not relative valuations. And I can go on a tangent. I'm not. I promise, Jay. I promise the audience out there I won't do it. But relative valuations used to drive tactical asset allocation shifts make absolutely no sense. We just talked about how valuations work over the really long term. They are useless over the short term. And so using that, which most players on the street do, right? They use, for their tactical shifts, they're using relative valuations, can steer advisors in the wrong direction. It can really hurt returns. It can cause a lag on the portfolio, right? And why do that to yourself, right? That's the painful part of value investing. What I like, and I know you've had guests, right, like Wes on here, who's been a huge proponent of value and momentum combined. When you see value and momentum or value and trend line up together, right? It's magical, and I think that's what you got to wait on before you take these overweight positions. And then you have to know what to do if you're wrong, right? Because just because the trends reverse doesn't mean it's going to stay in place. We have no idea how long these trends will last. We can guess, we can pontificate, but we don't know, right?
That's right.
You just have to trade it, and you have to have your processes to exit and enter, and know what you do when you're right, know what you do when you're wrong. And so that is a very difficult area. But that's an area I see a huge opportunity. Pretty much the rest of the world against large cap growth makes sense from a valuation perspective, and you're starting to see short-term trends reverse. If we get confirmation on intermediate and longer-term trends, that could be a great opportunity, right? In that same vein, gold is just getting started against stocks. That trend reversed in gold's favor in 18. And if you look at that chart of stocks or gold priced in, stocks priced in gold, right? So just take S&P or the Dow, divide it by gold on any charting software. You'll see that peaked a long time ago, and you've made a series of lower highs and lower lows. That is a negative trend. And if you look at it over the very long term,
I'm sorry to interrupt you. This isn't the chart of what you're talking about, but this is the chart of gold and the performance that has had over the past year, which is just astronomical considering how much hate gold had in our world 2 years ago.
That's right. And everybody's like, oh, gold's a crowded trade. Well, I don't know about that. I mean, gold rallied against stocks from 2000 and I guess it was 2000 to 2012. It's a 12-year period of outperformance in the favor of gold. And then stocks outperformed gold ever since then. And that's just reversed again. So who knows? That trend can last. And if I make the case that I see the Federal Reserve's balance sheet doubling, I see other central bank balance sheets doubling, I see the Swiss National Bank printing money and buying tech stocks. I mean, when you look at this, how are you going to ever fight inflation? We already saw it. I don't know if you caught the Wall Street Journal article today, but you're already starting to see the word overshoot. And I imagine that's going to be a very popular stance and popular word referenced by financial media in the months to come as it relates to Fed speak. Because when when you're in a stagflationary environment, the Fed's in a box. If they ease, they run the risk of, guess what? Inflation overshooting the target. If they tighten, they hammer growth, right? And you run the risk of going back into deflation, right? So I think what you have now is this interesting environment and box that the Fed's in, and it really plays out well for gold. So I can make the fundamental argument. I can look at the ratio and see that this is just an early move potentially of a trend. And then I see gold trending upward and outperforming equities, and it makes a lot of sense. So I still think that and potentially other precious metals trades are a better place to be. And this is all about where's the best place to be for my capital. And so I think I could see those trends really manifesting. I think there's a continued opportunity in precious metals.
So let's talk about that for a minute. So I pulled up the ETF Action website. If you have not taken a look at ETF Action, go sign up for their free trial. This is an incredible tool to dissect ETFs and look for opportunities. Let's use it to take a look at opportunities in precious metals. Tell me, what do you see? And then where should advisors have caution, as most of them, if they've been in the business for a while, have been burned by precious metals as well?
Yeah. So, when I'm talking about these trends, we're talking about longer term trends, right? Shorter term, they're all pretty extended as a percentage of above the 200-day, which you have featured here, right? Especially if you look at silver at 35%, or at least the SLV ETF, 35% above the 200-day moving average. That's pretty extended. But there's something called good overbought, and there's something called bad overbought, right? And a good and bad are opinions. So I'm going to be opinionated here for a moment. That's me denoting something, right? It's me saying, oh, this is good or this is bad. But I'm really looking at it within the context of performance. Just because something's overbought doesn't mean that it won't have good returns going forward. I challenge everyone, just take the S&P 500 or whatever, right? And I want you to do a quick test. You can go on FinViz and do it, but just do a quick test and say, when this particular security or index has crossed above 70 on the RSI, which is the relative strength index, the measure of momentum, essentially. Historically, people have thought that 70 is overbought and 30 is oversold. So theoretically, buy low, sell high. Doesn't really quite work out that way. You actually get better results historically on just a simple back test in the S&P 500 buying when it crosses above 70 than you do buying when it crosses below 30. Come on. So
put your CMT hat on for us here. Walk us through that trade.
It just shows you that momentum is strong. And when you're crossing above 70, just because that's some line in the sand historically that people have denoted as overbought, right? A line in the sand doesn't mean the market can't continue to run. And sometimes good overbought results in a really strong positive trend. And the goal is to capture those strong positive trends. So when we're following a trend, at the end of the day, if it's overbought and you get the trend positive signal, you buy it. You put your stop loss in. You have your exit program for when it does what you want it to do or doesn't do what you want it to do. Right? You know what you're going to do. You know what course of action you're going to take, and you forget how extended it is or overbought according to historical measures, because it could just consolidate. Right? It could just go flat for a little while, and guess what? It's not going to be overbought anymore. So I think
that's going to take some discipline, right? If your trading strategy has you allocating to the asset class or to the security when it crosses 70, you have to have a strong sell program in there.
That's right. You always have to have your risk management. You have to have your position sizing. You have to have your risk management, and you have to have your reentry. We've talked to people who are running portfolios and they're like, yeah, I got a stop loss on it. I'm like, okay, well, how do you know to buy back in? What do you buy back in on?
Mm-hmm.
Stop losses aren't foolproof. You're not going to, every stop loss ain't going to result in it crashing 20%. There could be a lot of whipsaws in there. And so I think at the end of the day, it's just, this all comes down to discipline. All investing, in my opinion, comes down to discipline. My greatest mistakes as an allocator, as an investor, have come when I have challenged, my system, when I've not been disciplined. And, it's that human quest to want to know everything, predict the future, and it's just not possible. We can form opinions based on evidence, but the most important thing is to just buy is to take your position and have solid risk management, right? Know what you're going to buy, how much you're going to buy, when you're going to sell, and how much you're going to sell, right? Know what to do when you're right, know what to do when you're wrong. And if you answer those decisions before investing a penny, I think you'll have a good experience if you stay disciplined to that system over time. I remember reading one time about Ed Van Thorpe, and I know he's here in or Van Tharp, I'm sorry, and he's here in my area, my neck of the woods. And I remember, I think it was trading against the Matrix or whatever it was, trading in the Matrix. I'm sorry, I'm butchering the name of the book, but one of his publications, he had talked about random buy signals and just having good risk management and having good results. And that type of concept is profound to me, because I think that's what it's all about. It's about margin of safety if you're a value investor, right? Mm-hmm. Risk management, it's about position sizing. It's about money management. If you're a trend follower, it's position sizing, stop losses, money management, right? It's all about those little things that aren't sexy and exciting, and they're not narratives and stories and themes. But at the end of the day, I think they win the day. And it comes down to discipline. It's about being disciplined and following the system. And I know Michael Guyette is on pension, you probably see him on Twitter a lot. And if you haven't interviewed him, I highly recommend it. But he said one time, we had a CFA, Society of North Carolina thing, and I got him to come speak. And he said, when he started off, the discipline to follow a system is better than the system itself. Couldn't say it better myself. So I'm just going to quote him, because I think that is true. And I think it comes down to this. And it comes down to this with all these themes, right? When I say emerging markets, when I say value, when I say gold, you see the extensions in these precious metals relative to historical overbought and oversold conditions. At the end of the day, when the trend supports the theme and you take a position, have good risk management, good money management in place, so that if you're wrong, it's taken care of.
Well, Clint, we had a comment from a live viewer. Amber Carter says, you only get hurt if you get off the roller coaster before the ride is over. She says she's not sure who said it, but she likes to use it. And I think you guys are saying the same thing.
Yeah, I like that. I like that a lot.
Awesome. Clint, thanks so much for coming on. It's always a pleasure to have you, because you're a wealth of information. I love this economic deck. Where can listeners and viewers find out more information about WealthShield?
Yeah, WealthShield.co. You can follow me on Twitter as well. Follow me on LinkedIn, and we're pretty open about all of our information. So if you need anything, don't see anything, want us to write about something, want us to test something, let us know. We're happy to do it. And we're running out of ideas. So
Maybe that's a show we could do, a live show where we test ideas.
Yeah, let's open
Actually
source some ideas. We need some.
Yeah. Clint, thanks again for coming on.
All right, thanks.